there's just a lot of microcaps out there. It's 55% of all public companies in the US. It's 70% of all public companies in Canada, and similar percentages around the globe. And most people haven't heard about any single one of these companies, but they have a big influence, over the economy, over everything.
Well, at the time of this recording, the S&P is down 23% year to date. The NASDAQ is down 31%, give or take. Large caps are down 24%. Mid caps are down 21.5%. Small caps are down 23%. And microcaps are down 18%, according to the MSCI index. So this really surprised me. And I was excited to have you back on because last time we were chatting, I was sort of under this impression that during a downturn like we're currently experiencing, microcaps might perform the worst because there's a lot less liquidity involved and you might get, no bid happenings, let's say. So how do you interpret the performance of microcap stocks year to date?
No, I think you raise a good point. And I think there might be 2 or 3 different reasons to kind of explain that. And you're right. Normally during kind of bear market environments, especially through recessions, microcap as a whole will underperform the overall indices. Even what I tell my investors that are invested with me is like, hey, if the market's down 30, we're going to be down 45. And if you're not okay with that, this isn't for you. And so that kind of explains the volatility. Normally the lows are lower and the highs are higher, but overall, hopefully you outperform the indices. I think what makes it unique, kind of what we're going through the last 6, 9 months, 12 months even, is the euphoria in the markets was mainly larger companies, and it was mainly larger technology companies. Most were small caps or mid caps or even large caps. And when you kind of look at the universe, which I'm sure you do and others do, you have Shopify down 80%. Even Netflix was a very mega cap company down 62% year to date. Even the SPAC boom that we had, most of those were majority small caps or larger. When you're looking at a market cap spectrum, and even the meme stocks, whether it's GameStop, even though that's down from whatever it was down to whatever it is, I think it's still a $7 to $8 billion market cap. And so those aren't microcaps, and so I think it got overheated a lot more in the larger tech stocks, which is why the NASDAQ, I think, is down 30% year to date compared to, the microcap indices, which I think the iShares Russell Microcap is down 25-ish. You mentioned 18, but it's down less than the NASDAQ overall. And so I think that's one of the reasons. I think another reason too is we haven't really seen, at least I don't think quite yet, maybe we will in the future, haven't seen sort of the recessionary effects of this drawdown. The overall market's down, but we haven't seen like some significant downticks in the overall economy yet. And I think if that hits in, you'll see maybe another leg lower in microcap. And I think maybe another reason is, microcaps as a whole, depending on where you invest. And, the biggest benefit to being a microcap investor is you are a stock picker. You can choose your spots and you can choose what companies you want to invest in. A lot of these companies are kind of domestic. They have domestic manufacturing, domestic employment, domestic markets. And so they might not be susceptible to the geopolitical, headwinds that we face or macroeconomic headwinds that some global larger companies may face. And so sometimes, being some of these small caps that are domestic is more of a defensive, posture as well. And I can't say that's in general the overall landscape of microcap, but I think those are maybe 3 reasons why microcaps as a whole have kind of outperformed even the NASDAQ year to date.
That's a very interesting point, that last one. So the first one you made, though, am I understanding correctly that you were saying it's almost defensive, and the fact that it's down less than, say, the bigger caps, was it because it was sort of underperforming to begin with? As things got frothy up top, microcaps were kind of buzzing along, but not as dramatically. And so therefore, the downside has been less as well.
No, exactly. I mean, I remember having conversations a year and a half ago, with investors saying, why would I want to bother invest in microcaps when I could just buy a large cap compounder and make 35% and have less drawdowns, over year after year after year, which is what we've experienced over the last 6 or 7 years. So, yeah.
Of all the downturns you've experienced to date, and I know there's been, quite a few since you started doing this, how does the current market compare?
I think this is the worst it's been that I've seen since 2008, 2009. We aren't yet to the level of fear that I remember from that time period. I mean, we all thought the world was ending, kind of like what I said in the earlier answer to your question. We haven't really seen sort of the economic hits on, at least here in the US, the domestic business climate quite yet. You do in maybe housing and real estate, but not so much. I mean, I still go out to the restaurant and it's full on a Tuesday night. You're still seeing the consumer out and spending money. So it doesn't mean that it's not going to get worse, and it very well could. But I do feel like it is probably as bad as I've seen since 08, 09. But it's certainly not quite as bad. I mean, the hardest part about dealing with kind of drawdowns is it makes you more and more short term instead of kind of pushing out your time horizon. And so, your portfolio drops 20% and you're excited to buy more, but then it drops another 10 or 20%. You're like, well, wait a minute. Then all of a sudden you're on the phone with management asking them the same questions you just did the month prior, because you just want to get that verification that everything's okay. And then you buy more, and then all of a sudden you just run out of dry powder to buy more. And then it drops another 10 or 20%. And you're just kind of frozen. And nothing's worse. Drawdowns are the most painful when you don't have the cash to take advantage of them. And, so that's one of the lessons that I went through in, last 2 or 3 kind of recessionary environments that I went through was it always feels good to at least have some cash on the sidelines, even if it's just a little bit, even if you're just buying another 1% of a position somewhere, over time, at least it makes it feel emotionally, mentally, psychologically like you're taking advantage of the situation, and so I think, what tends to happen too is like the lower things go, the more you turn yourself, at least for me being a stock picker, the more I start thinking about the macro market, inflation, interest rates, Elon Musk, whatever the case may be, things that are distracting me from kind of the micro focus. And so everything just gets you thinking more short term, like you can't mentally handle being down another 10 or 20%. So you just tap out. And so it's important to just kind of stay in the game, stay in mentally and emotionally.
You brought up Elon. I have a quick question there about that. So there's been a lot of signs, let's say, about what the top was of 2021. And it seems like, we ran up all the way to the end of the year. But around November, December timeframe, Elon sold about almost 7 billion worth of Tesla stock, something he said he'd never do. You had things like Beeple NFTs selling for 69 million. You had the meme stocks, as you pointed out earlier, 600 or so SPACs IPOing. I mean, looking back, was there anything that signaled a definitive top in the microcap market specifically?
It's a good question. I think it was just a combination of all those things. I think people point to whether it was Elon Musk selling or point to Chamath and the SPAC boom that took place. And maybe the SPAC boom was maybe a better gauge because, I mean, you generally, with the SPACs, you had sort of $100, $200 million revenue businesses that were growing 100%, but also losing $100 to $200 million a year, and, it's just like, how's that sustainable? And I don't want to be I don't want to hit on SPACs as an investor's vehicle or anything like that. But I think, it was a combination, I think, of everything. And it's hard to disconnect from that type of environment and stay rational, because I was fairly fully invested then and I'm fairly fully invested now, and so you just kind of have to step back and be okay, be emotionally neutral towards the current environment and keep to that kind of 3, 4, 5 year kind of investment time horizon looking out.
As investors, we're always trying to do that, be emotionally neutral, as you just said, and keep a stoic approach to investing, almost as if we're sharpening the skills in preparation for times like these, right? I feel like a lot of discussions I've had in the last 2 years have been sort of like, okay, when the time comes, we'll be ready, right? But what tools have you used to keep you calm through the current storm we're going through?
That's a good question. I'm a concentrated stock picker. I've always been. I was more concentrated in my youth, but I'm still probably fairly concentrated now. I'm primarily looking to invest in the best 6 to 10 companies, I could find. And to do that, you have to do the work and build the confidence to own these things through any type of volatile environment. I'm not a big fan of saying that you must be stoic or you must be lack emotion or you must get rid of your emotions. This is a very emotional game that we play. I'm investing in my family's livelihood. I have 70 other families that have given me some portion of their capital to invest with me alongside. I take that seriously. I didn't make that money. They gave it to me. I take that trust, seriously. And so I think a certain degree of emotion is good because it gets you up at the start of every day and keeps you focused on what you need to do to get the job done. And so I know for me, with drawdowns, the way I kind of stay emotionally neutral is understanding what I can control and what I can't control. And even the things I feel like I can control, I'm not really in control of the outcomes. So what I can control is the macro environment. What I can't control is where interest rates are going or when they're going there, or inflation, or whatever, who's going to go to war with whom. And so the way I deal with that is really paying attention to the micro focus, really handling that at the portfolio level. And, I think I may have explained this in a previous interview with you, but, I really have, call it 6 kind of attributes I'm looking at when I'm investing in a business. And it's very particular, kind of 2 top level ones. So a combination of scarcity and tailwinds. I'm looking for one of one businesses when I invest in them, not one of 1,000. I'm not looking for another company that's marketing the same product or service as somebody else, just a little bit differently. Really, truly looking for one of ones. And it's just like, Picasso in the art world, like the prices go up and up when people when there's something that's scarce, it's in demand. That's what I'm looking for. And then also obviously tailwinds, it's easier to invest when there's a tailwind in your back rather than a headwind in your face. And so that's kind of like the top level, but the kind of getting down into the 4 kind of key attributes is I'm really looking for businesses that can grow through a recessionary environment. And there's not very many of them out there. I'm also looking for a business that has a balance sheet that can weather the storm of a bad economic climate, not only to weather it, but to be aggressive, so they can acquire a competitor, when their competitors, really can't because they're either over levered or they just financially can't do anything. Also, we talked about intelligent fanaticism, I think before. I'm looking for those great leaders that show signs of intelligent fanaticism, that put great management, build a great team around them. And, lastly, obviously looking for a valuation where I can at least double my money, or at least I feel like I could double my money within 3 years. And what's exciting about the current environment, to that last point, is, the last 6 to 12 months, specifically in microcap and also elsewhere, is you've had multiples contract, significantly. And so for the first time in maybe a half a decade, you see that you might be able to have multiple appreciation again, which is pretty stellar when you look at some of these businesses, especially if you're investing in good ones. The fact that, hey, we might get, multiple expansion again. And that's really how you get multi-baggers. You get multi-baggers from really growing earnings per share and then multiple expansion over time. And so I'm really excited about the current opportunity set. And then lastly, we already hit on it before, but just being able to have some cash on the sidelines to take advantage of these opportunities, is really, really important.
That cash component is interesting to me because it takes a certain amount of discipline, and probably quite a lot of discipline, to have that cash in this current moment, right? Without maybe liquidating along the way. So has this been a cash position you've been either holding or building over the last couple of years, and you're kind of getting some gratification from having done that?
No, I wish I could say that. Well, maybe I don't wish I could say it was true. I'm not a big fan of holding a lot of cash. I have some good friends who are great investors too, that, they've been 30-40% cash, since 2015. I'm talking about just even having 5-8%, cash that you can take advantage of situations. And sometimes that cash that comes into place from, selling out your worst idea, and redeploying that into your best ideas. So it's not just a static cash position, but it's just kind of redeployment.
So you don't have 120 billion sitting around like Buffett. I got it. Okay.
Yeah.
So
not yet.
You mentioned this defensibility again. I'm kind of curious, with the rates rising as swiftly as they are, You said you're seeing an increase in opportunities. I'm also kind of curious though if you're seeing an increase in risk, right? Because a lot of these smaller companies, they might be just more vulnerable. Maybe they've got a strong balance sheet, but the liquidity is going away, and maybe their access to cheap debt to continue building is going away. How is that sort of impacting the current opportunity set for you?
I would say it's mainly a positive outcome, the current environment. Because like again, I'm mainly looking for really great businesses that are cash flow positive, that have good balance sheets. That I'm mainly, and when you look at across the ecosystem of microcaps, I think 18% are profitable, and so right there you cut out 80% of the ecosystem, right out of the gate. Um, and so I think and that's what I tell people for the first time that are looking at microcaps. I think it's easy just to look at the next story stock, that doesn't have any revenue, but I try to caution people towards that. And you can do that later on, but to start out, I would tell people to look at the income statement, focus on the profitable businesses that are out there. And that probably cuts out 95% of the issues you'll have investing in this space.
You mentioned having companies also that thrive through a recession, which is really interesting. I'm kind of curious though, with the investors you have now, are you resetting expectations even further a little bit, saying, hey, we had this basket of stocks, but they're going to grow a little slower over the next couple of years, and what that's going to do to performance? Or do you feel like this is actually going to propel some of these companies forward?
I think the way I position it with investors is, every investor that invests alongside me, even when they were coming on 2 years ago, during the height of the bull market, it was, we're going to have the market's going to draw down 30%, we're going to draw down 40. And that's just the way it's going to be. If you're scared by that, and obviously it's easy for them to say, oh yeah, I can take the volatility, when you're in that moment. But, I think you really have to guard against people having irrational expectations. And so, I think for the investor standpoint, I warned them, and I think I have a great group of investors. They're mainly small business owners, to be honest with you, and they understand the complexity of small business because that's what we invest in. And it's been a benefit there. With regards to the companies, very few, if any, have seen a decrease in growth rates. A couple of them have seen an acceleration of growth rates. And so that's why it gets really, really attractive. If not to be too simplistic, but if I think a business is going to grow 25% a year over the next 3 years, which is basically a doubling of their revenue over 3 years, and the multiples investors are currently willing to pay for that stock are at historic lows, I know that probably the return on that investment will match the growth rate of that company. So I would expect to hopefully double, the stock would double over the course of 3 years. But if the multiple actually starts to expand again, that's where you get the leverage on that. And that's where you get 2, 3, 4x on your money over a course of 3 or 4 years. And right now it's a very opportunistic time because you've seen the multiples contract, 50, 60, 70% in some cases for businesses that are profitable, that are still sustaining high growth rates.
You mentioned this was the most similar to 2008 that you've experienced. And I didn't really get the opportunity to invest in 2008. I wish I did to some degree. I know it was a very painful experience, but gosh, there were a lot of opportunities that came out of it. And not a lot of people, I guess, really think about this, but it took quite a long time for it to bottom out, right? It took like almost a couple of years. And so if that's sort of what's ahead of us, what's kind of throwing me a little bit, and I'm kind of curious on your take here, is that everyone seems to be bearish right now. And I know that maybe in the markets and in the professional arena, that was the case in 2008. But on Main Street, I don't remember that being so much the case, just people not being so privy to what was happening exactly in the market. So now that I'm more inside of it, I am just looking around being like, wow, well, you always hear this idea that, the herd is not always correct and you got to go against it. So when I see everyone as bearish as they are now, it somewhat gives me pause, even though this time is probably correct, where people are just seeing all the same signals and it's going to play out similarly. Have you been experiencing something similar to that in any degree, where you're looking around saying, hey, I've seen this movie before, but does it give you pause at all? I'm just kind of curious.
No, it is, and I think you're right. I mean, usually the loudest voices are bears. And that's just how it is. It's how it's always been. And compared to 2008, 2009, there's, so many more ways for people to have a voice, whether that's podcasts or whether that's, social media or what have you. And so it does seem louder, it does seem like everybody is bearish. And it does get me excited about the opportunity set. And I think what also, just because the overall markets go down more from here potentially, it doesn't mean that some of the equities that you're invested in, they might not go down. Like some of the small cap and micro cap stocks on my watch list, a lot of them hit their lows May, June. They, and they're still 30-40% off the lows. So it doesn't mean like if the stock market goes down another 10%, that everything else needs to go down 20, or even make new lows. So you always have to be looking at where's this business going to be in 3 years, and kind of just keep to that time frame. It's so easy to just get caught up in what's next quarter going to look like. Probably the worst environment that I saw was actually during Q4 earnings for last year, which would have been, I guess that would have been like March time frame. And it was that was the worst earnings period I think I've ever seen, where companies would come out and they would beat estimates and their stocks were down 10% the next day. If they met estimates, they were down 20%. And if they did not meet estimates from analysts, they were down 40. That's when you saw like these huge drawdowns in some of the mega caps. And that was just an awful time period. Like you were just it's like you're juggling dynamite as an investor going into the earnings call because you didn't know how bad it was going to be. You just knew it was going to be bad. So a lot of ways it felt worse earlier in the year. So I guess maybe just the point I would make is just because the market may go down doesn't mean that the stocks that you own will go down, especially if they're higher quality. And that's what I realized through the 08-09 time period. I was mainly in 3 companies, and one of them was down 62% peak to trough, but it troughed in late 08. And I think by late 2009, it was already back to its highs. And 6 months later, it was doubled from there. And so what you see is kind of a lot of times quality bounces back first, and I think it usually bottoms first, because people want to look at quality first to get, to dip their toe back in the market again. And that's what I experienced back in 08-09. The other thing I experienced kind of to benefit microcaps was, even in that environment, there were still larger investors and larger pools of capital that were interested in owning things that were growing rapidly, earning more money, not diluting, that they didn't own. And so there was still bid support in undiscovered, profitable, growing businesses.
Speaking of dipping their toe in, something we're seeing right now, which is kind of interesting, is private equity taking an interest in the public markets. You had Brookfield allocating around 110 billion. What is the implication of this? And do you think we'll start seeing a lot of, I guess, an increase in companies going private maybe in the next year?
I wouldn't be surprised by it. I mean, if you think about it, I think there's usually a 6 to 18 month lag between private valuations and public valuations. So public valuations get hit first, and then it takes another year or so for private valuations to catch up. And kind of in the interim, you have people racing to raise capital to take advantage of public equities being lower. And you saw that you mentioned Brookfield raising 110 billion. Historically, on Microcap Club, we've had, I think we're up to 880 companies profiled by our members since 2011, so over 10 years. And I think about 18% have been acquired, which seems like a big chunk of companies, and it is. But I think it tends to ebb and flow more with kind of the valuations overall. So I would not be surprised to see a lot of M&A activity really spark up and get more robust over the next, 6 to 12 months. And I think that's what you see in Brookfield, $110 billion raised, mainly focused on kind of Canadian public companies, which is interesting. And to give you an idea of the size of 110 billion, we all know what that is and means. But if there was a paper written, by Dr. Parrott of Parrott Funds, I think it was back in 2008, 2009, called the Microcap Advantage. And I remember reading that, and it was like halfway through that white paper, he talks about just the size of the microcap ecosystem in the United States. And back then, and this was obviously 12 years ago, I think he said it was around 300 billion, the entire microcap ecosystem in the US. And he kind of went through it and said, okay, well, let's just say, a third of these businesses that are microcaps are insider held. And then let's say the other third, let's just say, is somewhat owned by their large holders or institutions. So that means that basically for $100 billion, you could buy the entire float of every microcap in the United States, $100 billion, which, I don't know if Apple or Berkshire has that on their balance sheet, but it's kind of funny to think about. So that kind of gives you the size of kind of what $100 billion could do, even today. And I think when I ran the numbers 3 or 4 years ago, I had a buddy that had Bloomberg, and I had him kind of like do some of the screening and figure it out. I think it was around 500 billion was the microcap ecosystem here in the US. So it's similar. There's 5 companies probably today that individually have a market cap over 500 billion. And that's pretty much the size of, the entire microcap space. I read an article the other day, and as I see an ant walk across my floor right now, it talked about ants. And if you were to combine all of the ants on Earth, like into like a ball, the entire mass of all the ants on Earth is actually larger than all mammals and all birds mass put together. Which is incredibly think about like the entire mass of ants, versus, all mammals and birds, it just shows how many ants there are in this world. I kind of compare that to microcaps. There's just a lot of microcaps out there. It's 55% of all public companies in the US. It's 70% of all public companies in Canada, and similar percentages around the globe. And most people haven't heard about any single one of these companies, but they have a big influence, over the economy, over everything. Here in the US, I think I looked and I think they support close to 3 or 4 million jobs in the US. It's probably 10 or 15% of the job market in Canada. It's a big impact, that microcap has.
I love that. It's interestingly enough, I've heard that ants are the most like humans, right? They're the most social creatures. They go to war with each other. I mean, really fascinating. You don't think about it like that because they're so small, but they have, man, a lot of similarities here. I'm kind of curious about your portfolio. A couple of things here. One is you mentioned having a strong balance sheet, but I know that you focus a lot on the founders and having them involved in the company. And sometimes that's an important check mark for you. Are you seeing founders doing something similar, meaning they've got capital, they've got some dry powder of their own, and they're buying back shares? Have you seen any of that start to happen, or is that something you look for?
It is. I mean, nothing's better than seeing a founder or management team put skin in the game, supporting the equity. And you are seeing that more and more, especially with businesses that have the business strength and the balance sheet to be able to take advantage of this environment. Because, if you're a management team and you just saw your equity go down 50, 60%, your best ROI for that cash in the balance sheet might be just buying your own shares, eating yourself, cannibals, as you would say. And you are seeing more and more of that. And that's, I'm also very attracted to that as well. As it relates to kind of my portfolio, and again, kind of getting back to kind of drawdowns, what I find too during drawdowns is, it really forces you to think deeply about what you own and why you own it. And I tend to get more concentrated kind of during drawdowns because, some of the things that you might have 2 or 3 things in the portfolio where you're kind of half convicted. All those things go away, when you watch things drop. You don't have time for things that you're half convicted in. And, sort of the best thing about this drawdown too, in particular, because there was some violence with the drawdown, depending on what you were in, is a lot of times the losers in your portfolio, meaning the things that you would like to sell, are down just as much as the winners, which are the things you want to buy more of. So it's allowed you to kind of upgrade your portfolio, through this. And that's what I've seen in my own portfolio over the last, call it 6 to 9 months, just getting more and more concentrated and upgrading the portfolio and really cutting the portfolio back to those positions that you truly, truly believe in, that you can't live without. I was listening to an interview with Rick Rubin, and Rick Rubin, he's one of the greatest music producers of all time. I think he worked with, was it Beastie Boys, Eminem, Metallica, Adele, Aerosmith, Dixie Chicks, Jay-Z, all across many, many genres. Just an amazing producer. And he part of the interview, he talks about how he believes less is more. In music, it's easy. You want to keep building upon the music, adding things to it, when in reality, a lot of times you should be cutting it away so you can hear each individual thing and bring them together. You can actually hear each one. And he talked about how he builds a successful album. And he talked about how usually, if you want to have a 10-song album, what they'll do is they'll work with the musician to work on 25 songs, and then they'll cut it back to 5 or 6 songs. And then they'll only add the ones that make it better. And I kind of compare that way he builds a hit album to how you should be building a hit portfolio. And that's kind of what I've done over the last 6 to 12 months in my own portfolio, is really just take it down from where I was at 10 positions down to 6. What are the ones I really truly believe in? And then from there, I'm only going to add something that makes that portfolio better. And so we've added maybe 1 position over the last 3 months during this drawdown, this environment. And I think that's a good lens to look at portfolio construction, at least for me being a concentrated stock picker. It's not for everybody the way I invest, and I don't say everybody should invest like me. I would hope you wouldn't, but that's kind of the way I think about it.
With the idea of stripping away, you've added 1 position. Have you taken any away? Have you stripped down the portfolio? Yes, you kind of mentioned there.
Yeah, no, absolutely. No, I mean, that's what I meant. We were probably at 10 positions going into the end of last year. Probably stripped down about 4 or 5 positions and took it down to the bare minimum, ones that I really, really loved. And then now adding as we see opportunity. And the 1 position we added is a company that I've followed for 10 years, that just, happened to inflect on some things where the valuation made sense and excited about the opportunity. So yeah, I stripped it down from 10 to 6 and now looking to add, but I'm fine with the portfolio being the way it is. I really am excited about what we own and why we own it.
Yeah, I love that. It's interesting because, I'm always reminded of that Amazon drop in the dot-com bubble where they went down something like 92%, but all of their fundamentals were going in the right direction, up and to the right. Right. And so I imagine that's what you're seeing a little bit, where it's not the price people are getting caught up with, but did you see a fundamentals shift that gave you kind of pause in your thesis?
One of the businesses that we in, I mean, just to show you some of the volatility, I mean, one of our largest position, we bought at, let's say, $10 per share, reinitiated position in early 2020. And then it hit 50 by the end of 2020. And then it went down 50% from the end of 2020 to the middle of 2021. And then it's just kind of meandered a little bit. And now it's probably slightly higher than what it was a year ago, even though we've gone through this market environment. I like to say, well, that position went down last year instead of this year, because the markets went down this year. But that business as a whole, that was what we invested in it. It was a, $15 million revenue business growing 30% a year. And today it's a $40 million revenue business growing 40% a year with 90% gross margins. And so from a multiple perspective at anything, it's a lot cheaper than when we initiate the position in it, and so you're finding, that's what I mean. Like the opportunity right now is you can find some really good situations that, the multiples have contracted down, they're growing into them. And eventually that equity is going to, take off again.
That Rick Rubin fact is kind of interesting about building a record or an album, and his studio Shangri-La is kind of interesting because there's apparently no art on the walls. He keeps the walls blank so that the artist doesn't have any impressions. The artist is able to create with no influence, if you will. But I'm kind of curious, as a portfolio manager, we're all looking for some kind of influence. Is there something you've been using as of late to kind of guide you and help inform you as you've been going along? Is there something that influences you or some resource that you build on, maybe outside of Microcap Club?
Probably the biggest asset I have is the relationships I have with other investors, and some of that is fostered through Microcap Club because it is a place where people, at least online, can meet and greet and that type of thing. But, just some of the relationships that I have with other investors that invest differently than me too. You can always learn a lot about yourself when you kind of meet Bizarro Trey or Bizarro Ian, where it's somebody that does the complete opposite of you, but is successful. like you can usually learn something from somebody like that. And for me, it might be looking at a deep value investor and seeing how they invest or whatever it may be. But I really am fascinated by learning from other folks that are really successful that invest differently than me, because there's usually one or two things that I can pick up on that I can apply to my investing that will be beneficial and accretive to me and my investors. I mean, you don't need to make these huge changes. That's a lot of times investor maturation isn't about making these huge step changes. It's about little tweaks on the fringes, and that's where the alpha is made.
Well, I imagine that was some of the impetus for starting the Microcap Summit. And I'd like to talk a lot about that here because you just recently held this. It's the seventh year you've been doing this, and you had 19 investors come and speak about strategy and even stock picks. So I'm kind of curious, just off the top here, what were some of the big, maybe headline takeaways that stuck with you?
Yeah, no, thanks for bringing up the summit. Yeah, that just concluded last week, and this year was virtual once again. And really, what the goal of the summit is, it's called the Microcap Leadership Summit. It's really to do three things. You want to have an event that educates and inspires folks. You want people to learn something. You want people to hear some good investment ideas, and you also want to provide the opportunity for them to meet other people like them. And a lot of that's easier to do in the physical form. And so this is our seventh summit this year. This is our 2021 third in a row that was virtual. But kind of virtual for us had its benefits too, because we've been getting more and more global as a community. And even when we had our event in Chicago physically in 2019, about half of the attendees flew in from overseas. So it's a very kind of international group. It's getting more and more global. So this year, it was a 2-day virtual event. The first day, I tried to handpick 15 to 20. This year was 19 of the best stock pickers in Microcap that I knew, to give short presentations, 20-minute presentations, kind of the first 10 minutes on their process, their strategy, what made them unique, and the last 10 minutes on their favorite Microcap at the current price. And so we had a wide diversity of types of microcap investors that presented from different areas of the world. And it was the first time we ever did something like this, at the summit, and everybody seemed to enjoy it. I mean, I always look at it as, okay, I'm pretty experienced in this space. What would I want to pay attention to from 8 a.m. to 5 p.m.? And this was pretty cool. And so we had a really big variety of investors and ideas, and we had deep value investors, the story stock investors, everything in between. And we're actually starting to publicize some of those on our YouTube channel, on Microcap Club's YouTube channel that we're pushing out right now. So if people want to listen in on some of them, you can do so. It's free. But it was a great event. So that was day one, and then day two, try to hand select a dozen kind of unique microcap companies that were very global. And so we had, even though we only had a dozen companies, we had 7 different countries represented, from Finland, Denmark, the UK, Australia, obviously the US, Canada, Belgium. And it was 10 million market cap companies and 300 million market cap companies. You had story stocks and value stocks. You had diagnostic companies trying to build an airline company. It was a full variety. And that's one of the tough things is the people that tune into our event. Not everybody invests the same, so you're trying to get a company or two, or at least the entertainment value, to where you can keep people interested in these presentations throughout the day. And I think we did that. I was really excited about the lineup we had this year. And so it was a great event. It just ended. It's like planning a wedding every year. So I'm glad it's over for now, but it's always fulfilling.
Were you experiencing through that summit more of a bullish or optimistic sentiment than compared to the bearish one we were just talking about?
Yeah, no, it is. I mean, I think there's opportunities I know for me, I don't know if it's a contrarian to me, but through what's going on over in Europe, I'm kind of more intrigued with what's happening in Europe from an investment standpoint, like what opportunities are there. And so I really tried to get some companies that were in some areas in Europe that might not be as susceptible to some of the challenges that other areas of Europe might be. So we had a company from Finland, where 50% of their energy consumption comes from uranium. And so they're not quite, it's not like Germany where, things could get really bad or things like that. So I tried to get some really interesting microcaps that were in some interesting in some interesting countries that I knew nobody would have heard about. Very few people probably in those countries have heard about those companies, but they happen to be publicly traded, on those local exchanges over there. And, I think we showcase kind of the best, some of the better, or a couple of the better microcap companies that are over in that area as well. So I know for me, I tried to have a global focus and also trying to understand a little bit that everybody was running away from Europe. Let's try to showcase some European microcaps that are doing things differently.
I think I know the answer to this one, but I have to ask because, something that stood out to me was a lot of these investors that spoke, they weren't solely, or I'd say a few of them weren't solely microcap investors, right? So they had a strategy that would kind of dip into micro, but other things as well. And so I was just kind of curious, no one pitched this, but when you see companies like Google or Alphabet, for example, today, trading at a PE of 18, right? Like, do you ever get tempted, right? You're a microcap investor, but you see some of these major caps or large caps getting fairly cheap by historical standards. Was that a topic of discussion at all? I'm curious.
No, we actually we actually make sure that we don't talk about that. No, I'm just kidding. Only microcap center. No, I understand. I think there is opportunity in large caps, and there's quite a few fund managers that presented on our day one of the event where they own 100 million market cap alongside Google, in the portfolio, and that's completely fine. Obviously, you don't have to be just a microcap investor. I think to anything, everybody's goal should just try to find the next great undiscovered company. Whether that's a billion market cap or 10 million. It doesn't matter. Who cares? Just go find it. Before somebody else. That's kind of our marching call for Microcap Club.
Beyond the stocks that were pitched at the summit, you featured the guests I just mentioned. That a lot of them had very unique strategies, which is, I imagine, the appeal and why you invited them in the first place. But were there a few strategies that stood out to you or interested you, maybe even surprised you from their presentations?
I'm probably somewhat biased, but there was a couple of presentations. Well, and all of these will be public shortly on our YouTube channel. So there's one that I really enjoyed. Harris Kupperman's was really good. People enjoy his communication style, and people would enjoy his presentation, which was just released. He's more of a macro type of investor that takes big swings, and he does own a microcap, and that's the one he presented. Another really great presentation was from Jason Hirschman, who's a good friend of mine. He's a full-time private investor, managing his own family office, and doesn't really have anything to sell anybody, per se, but he gave his presentation itself on his process, his strategy was just really, really unique. And he's a phenomenal investor. That's kind of the interesting thing about microcap investors and investing in general. Like, some of the best investors I know aren't necessarily hedge fund managers or professional investors. Sometimes they're small business owners, and the best investors, really the key attribute is you're trying to find out the truth on a company. That's, if I, boil it down to first principles, that's what it is. You're trying to find the truth, and so, whether that, obviously you go into every situation, reading filings, reading press releases, listening to earnings calls, reading earnings transcripts, but that's all information the company has put out for you to read or hear or absorb. You really need to get out there and dive deeper into the situation to find actually what the truth is behind a company and where it's going and where it's positioned. If I want to find out about you, Trey, obviously I'll talk to you, but if I really want to find out about you, I'll talk to your wife, I'll talk to your best friend, I'll talk to your business associates, and that's what it takes kind of in the microcap world to find out what's really going on.
All right. You mentioned Harris Kupperman. He's also known as Cuppy. A lot of people call him Cuppy for short. And I really liked his stock pick that he presented. You just released this along with a few others, as you mentioned. For those who are unfamiliar, we interviewed Cuppy in April. It was episode 428. And he pitched a stock called Lee, L-E-E. And Lee provides local and regional news and advertising services in the US, which, might sound like it's just a melting ice cube at this point. But actually, there's this digital revenue portion, silo of the business that's growing quite rapidly and the biggest contributor to the EBITDA. the enterprise value right now is around 600 million. The market cap is 100 million, as you mentioned, growing revenues and free cash flow. I mean, this is a really interesting stock. I mean, and the annual volatility is around 50%, which stood out to me. But you know what? Almost every stock we've talked about or that was pitched, it seems, in the microcap world has a volatility around 50%. It seems to be kind of par for the course there. So not a major asterisk, but something to be familiar with. I just found it really interesting, and I kind of thought that was something to maybe explore a little bit further. But another presenter was Paul Andriola, and Paul appears to be the best performing investor in the club. I mean, his stat is almost 10x. It seems like anybody else that's on the platform there. How would you describe his strategy, and what was it like to kind of learn from him?
Yeah, no, I've been friends with Paul for a lot of years, and the way our ranking system works in Microcap Club, which is what you're referring to, is every company that you profile, we collect it, see what the starting stock price is, and then you get points based on the performance of that stock pick. So if I profiled something at $1 and it goes to $2, you get 100 points. If it went to $3, you get 200 points. So the percentages are basically the amount of points you would get. And it's detractors too. If you profiled something at 10 and it goes to 5, it works in the opposite direction. And so he happened to be the one that profiled Expel a long, long time ago. I think at like 30 cents, and it went to $100 per share. And so that's been the main driver of that return profile. Ironically enough, Jason Hirschman, who I talked about earlier about paying attention to him when his presentation comes out, he actually owned 5% of that company from $1 to 100. And so he's sort of the GOAT of holding that company. He's an incredible investor. And so Paul, he is really, really good at finding these small, high growth, profitable microcaps in Canada. So that's kind of been his focus for the last 20 years, and he's really, really good at it.
It only takes one. Seems like that's quite impressive.
It's sort of to your point about Harris and Lee, and not specific to that company in general. You see that quite a bit in microcap, where you have a business where one part of the business is declining, another one is accelerating. Overall, it's showing that the company's not growing at all, maybe even declining, when in reality there's a smaller part of the business that's growing rapidly. And it might be a business like that where it's newspapers, as well. So we're like, I don't want anything to do with that. It doesn't screen well because it's not really growing, So you find things like that. And it's why it's also important to dig below the surface of the financials, in all of these businesses, because you can find some hidden gems, that are kind of about to kind of break through, and hopefully be found by a majority of investors, and a lot of that means you just have to do the work to read through the file leads to find out those situations. And that's a big part of what we do as well.
Now, did you present at the summit, or did any of the Microcap Club founders present? Because I imagine people want to hear from you as well.
I imagine they would, but I was the MC for the entire event, so I was exhausted. I would much rather put other people on the pedestal rather than myself. So I just played host the whole time.
Fair enough. If you were able to see the future a little bit, and you knew we were going into another year or two of a bear market, would you do anything else to hedge? And I guess what I'm kind of asking about is maybe not hedging in the stock market, but do you look to other asset classes outside of microcap stocks just for your general portfolio?
I don't, but I'm not advising that. It's just, this is microcap investing is the only thing I've been doing since I was a teenager. It's the only thing I feel like I have an edge in. And every time I've tried to get into other things, I've gotten my hands slapped, so I just kind of focus on this niche of the market. And, if I knew the US is going into a recession for the next 6 months, 12 months, however long, I probably wouldn't do anything differently than what I'm doing right now. And I don't hedge strictly long only in a concentrated portfolio of microcaps. And my way to hedge is just being in the most unique, best companies I can find that are growing rapidly, that have great balance sheets, that can endure a recession and take advantage of one. And that's kind of the way I try to hedge out my risk. It doesn't mean that the portfolio will not be volatile. It certainly will be, but in the long term, I always kind of keep to that 3 to 4 year, 5 year type of time horizon.
So Sid Grover from Canterbury presented TDW at the summit, and that kind of raised a question for me. I mean, given everything we're seeing in the market, did a lot of people come out with energy opportunities? Was that a bit of a theme, or was he kind of alone in that space?
No, he wasn't alone. I think we had maybe 2 or 3 investors. I believe Michael Melby, who's going to be coming out shortly. He runs Gate City Capital. That'll be another one to pay attention to. So, Michael Melby, he runs Gate City Capital. It's a hedge fund. He's mainly deep value, which everyone in deep value up until the last 6 months have gotten decimated, as you know. But I think he's up 700% in the last 9 years compared to 200% for the S&P in a deep value strategy. Maybe that's somebody you should pay attention to. So he pitched an idea. I believe his was energy. And then Josh Young as well presented, and his was obviously energy too, because he's energy centered. So I think there was 3 energy ideas.
So beyond these summits that you've been putting on, how do you currently, spend your time building your knowledge? Are there books that you've been reading or currently reading? And do you stick to fiction, nonfiction? Like how else do you influence yourself as the artist we were speaking about earlier?
Yeah, I mix it up. So right now I'm reading Crime and Punishment.
Oh boy.
So I've got to go. I'm going through a novel phase. I've just been kind of going through some novels. I mean, from a pure investment book standpoint, after you read 100 books on investing, the value gain from an incremental investment book kind of goes down and down. And so, most of kind of what you learn from that point forward is through the experiences that you get as well. And so a lot of my reading is, well, on the pleasure side, it would be more novel related. And then on the investing side, it would be reading obviously on individual companies and industries. So it's mainly focused on those 2 areas. And I used to, spend probably an hour or 2 every 2 or 3 days, just doing art, charcoals and stuff like that. I do find it's beneficial to kind of stretch the other side of the brain, because what we do is very quantitative. It's good to kind of, and that's why I think I've gotten into this novel phase, kind of lets the imagination go a little bit. And a lot of times that's where, your creativity is fostered too. It kind of gives your brain some gaps to form ideas. And so it's important for me. It's part of the process. But right now, reading Crime and Punishment, probably read another novel after this one. The investing books that I read, obviously I like William Green, who's host on the Investors Podcast. I read his book. It's amazing, but primarily it's industry or company centric reading on the investing side. Probably the next question that's coming is probably the best book that I've read for investing in microcaps is a book called Sleuth Investor by Abner Mendelman. And it's all about sleuthing and how to try to find information on companies. It kind of gets back to the point I made before about the key to this is just finding the truth. And that's a great book on how to sleuth and try to find non-public public information on companies. That's the best way to put it. Unique public information. So, that's probably the best book that is the most applicable to microcap investing. I think having the skills of a financial journalist or any type of journalist, type will do really well at microcap. Just digging.
Very cool. And with Crime and Punishment, I'm curious, is that sort of one of those things where, you spent years or decades even reading all these nonfiction class, and now you're finally getting able to go back to the classics that you never got around to? Because I've experienced that for myself as well.
It is. No, that's exactly right. You hit the nail on the head. Like I got a stack of books I've been meaning to read for feels like 20 years that I'm finally getting to. So you're exactly right.
Yeah, I have to agree. I mean, fiction is almost more important than the nonfiction in some ways. There's a lot of research that goes in, and definitely you can learn almost as much or more. Sometimes I'm not as good about reading fiction. I got to be honest. Well, Ian, it is always such a pleasure to have you on the show. I always look forward to these discussions. Before I let you go, though, I'd like to give you an opportunity to hand off to the audience where they can learn more about you and Microcap Club, the summit, any other resources or books you want to share. We'd appreciate it.
Sure. No, and thanks for the opportunity to come on the program again. It's been a pleasure. People can find out more about me at microcapclub.com. You can also find me on Twitter. That's at Ian Cassel is my handle. I do run some outside capital, and that website is www.if.capital.
Now, can anyone join the Microcap Club? What is it? What are sort of the qualifications and/or requisites?
Sure. Yeah. So anybody can join. You can join in two different ways. You can either become a member or a subscriber. So to become a member, which means you can participate on the forum, you write a 2 to 3 page investment thesis on your favorite microcap stock. And we usually get 20 to 30 of those applications every month. And at the end of the month, all our members vote on each one of those applications. And if you get enough votes, you get in as a member. And if you don't, you don't. Usually about 10% of people get in. That's usually the hurdle rate. And so that's one way to join, and that's free. Kind of get in on merit. And you can also join by subscribing, which it's $500 a year, and that's view-only access of the forums and the conversations that we're having internally on microcapclub.com. And so internally, it just looks like a message board where somebody profiles, company XYZ, they write up a thesis, and that starts the thread, and that starts the conversation. And since 2011, we've had over 800 companies profiled on there by our members, over the last 10 plus years. So it's a great way to find ideas. It isn't a guru service. It isn't here, take Ian's 10 top picks and go make money. This is strictly, I want to find out what a bunch of smart people in this space of microcap investing like and why. And then it's up to you to kind of make up your own, decision on what you want to do with that information.
Well, I really encourage everyone to check it out, and especially these summits. These are unbelievable resources you're putting on. I appreciate you actually distributing and disseminating the presentations, and for free. You can check these out on YouTube, and they're 20 minutes long. They're packed with amazing information from incredibly smart people. So I highly encourage you to check it out, everybody. All right. So with that, Ian, I really appreciate the time, and I hope to do it again soon.
Thank you. Thanks for having me on.
Paul Volcker one weekend increased interest rates or federal discount rate by 200 basis points. And he didn't tell anybody he was going to do that. And they didn't really explain it that much afterwards. Today, the Federal Reserve, in part because Jay Powell is much better at this than other people, he's willing to say, here's what we think we're going to do. Here's how we might change our mind, but here's what we think we're going to do. And then after they do it, they explain it right away.